I'm excited to share Bill as an exclusive sponsor of the Thrivecast. They have been sponsoring the Thrivecast for so long. Thank you, Bill. Our firm has been using Bill for over a decade now. We actually use it in all of our foundational CFO and controllership engagements. We have to turn all of our clients' financial processes digital, and we do that with Bill. And you can check out some webinars and blogs and even toolkits that I build with Bill to help in your firm. So thank you, Bill, for being a sponsor of the Thrivecast. Hey, everybody. Welcome to another episode of the Thrivecast. We are excited. We love to give great, amazing content to firm entrepreneurs all over the world to help them really figure out how to grow firms. And we've got somebody today that's really going to help us do that. But I do want to say, when this podcast comes out, we'll probably have 1, 2, or 3 tickets left for our Deeper Weekend Conference, which is on acquiring, selling, merging, scaling. And the profession is needing this information, and our guest today is going to really help us understand that, navigate through that. So we're really excited. So check out, go to Thrival.com, hit the Deeper Weekend navigation at the top of our site, and let's just see if you hit a waiting list or you even get a ticket. So you may not. So do that quickly so you can come see us. So I'm excited to have Brannon Poe of Poe Group Advisors. Everybody knows his name. That's always trying to, they're always fiddling around on his site, trying to figure out what firm would I buy next. So Brannon has been brokering and selling firms for over 20 years, sells them in U.S., Canada now. And I have a lot of questions about that. He was with Ernst & Young, a long time ago. So now he sells Thought Leader. He's got books out. They have courses. They have ebooks, which we're going to put in the show notes. They've got ebooks that help sellers. They've got ebooks that help buyers. They just walk everybody through this whole journey of how to buy a firm or how to sell a firm. And they run a lot of this through their Accounting Practice Academy, actually an academy to teach people how to do this. So I'm pumped. Brannon, welcome to the Thrivecast. Thank you so much for being here with us. I really appreciate it, man.
Yeah, I'm excited, Jason. Yeah. Thank you for having me on.
Yeah.
Look forward to talking about these things.
For sure. And I get to be on your podcast too, which is pretty cool. Coming up soon.
It's very cool.
Yeah.
Yeah.
Very cool.
We record next week.
Yeah, I think so. Yeah. We record next week. Okay. Brannon, this is so cool. I'm sure a lot of people would love to pick your brain. So I'm going to see if I can pick your brain on behalf of all of our listeners and people on YouTube also. But how did you get into selling firms? I'd love to know that story because you were, I guess, a practicing CPA, right? Ernst & Young? Or how did that work out?
Left. Yeah, I had already left public practice. I was actually working in Charleston for a waste management company as their controller. And I realized I had 3 small children, and I said, I don't think this controller thing's quite going to cut it for me. And so I started. I had a mentor that told me, you just got to go out there and start turning over stones. You just got to keep looking. And he said, you keep looking, you'll find something. So I just kept thinking about that. And a friend of mine in Columbia had bought a CPA practice, and I was up in Columbia for CPE. And we went out after the conference, and we were shooting pool and drinking beer. And
that's how you start a business, right? Shoot pool and drink beer.
You start a business. That's right. And he said, you should call the guy. I bought this practice from him, and all he does is sell CPA firms. You should check him out. So I'm like, that sounds pretty interesting. So I go back home to Charleston the next day, and I can't remember the guy's name. I'm terrible with names. And so I was like, so I contacted the wrong guy. I contacted this guy in Dallas, Texas, named Howard Holmes, who was just starting a company called Accounting Practice Sales.
Okay, I knew that. I've heard of that one too. Yeah.
So Howard was one of my favorite people I've ever worked with, and he. He said, well, I don't have any practices for sale in Charleston. would you like to sell CPA firms? And I said, well, maybe. And next thing I know, I'm getting on an airplane. I'm going to Dallas to meet with him, and he signs me up that day to sell firms in South Carolina. And so I started selling firms. I was the sole breadwinner for our family, 3 kids. I couldn't quit my day job, so I started this like as a sideline.
Oh, I see.
And
you're a true entrepreneur if you're doing that, man.
Yeah, I was working like 7 a.m. until 11 o'clock at night. And I went to my wife and I said, look, this is going to take a commitment to get off the ground. Like, I'm going to have to work really, really hard hours for a year, 2 years, something like that. And she's like, well, let's do it. I'm on board. So she got on board. I had less than no money back then. And so I didn't even have a laptop. I went and bought a laptop on my credit card and, did my first advertisements on borrowed money and got this thing going. And I just worked like crazy for a couple of years. And then Howard sold the company. I almost bought it from him. He was kind of offering it out. And anyway, when he left, he ended up selling it to an insider that was already a partner. And so I left when Howard, when he left, I was kind of like disinterested.
So you hung your own shingle. You just like.
I did. Yeah, I did. And
had you done a lot of sales at that point? Like after work?
I had been there. I was there. I'm trying to think. I think he was there for 5 years, and then he sold.
Okay.
After I had been there for 5 years, and then there was a period of time where we were I was trying to negotiate with the new owner my exit.
Oh, I see. Okay. Now, how did you? It was probably years ago because everybody in the profession is always browsing your site. All of us firm entrepreneurs, we do that. You must get a lot of site clicks, Brannon.
We do everything we can to get a lot of site clicks. Well, so we do. Yes.
Well, and you guys are well branded. Well, and even you've just been doing it for so long. People just type in your URL now, so we look it up. But I saw you were selling stuff in Canada, and I can't remember. I know that was years ago, and I'm like, what the heck? What's he doing selling stuff in Canada? How the heck did that happen? Yeah. Well, and what made you do that? That's interesting.
So my next door neighbors, who were dear friends of ours and we were really close with, were from Canada. And it's probably over a beer one night, and they say, you should go into Canada. So,
man, this I need to drink a beer with you. Like, there's no telling what would happen to my life.
That's right. Like all kinds of creativity starts, right? But yeah, so he was like, yeah, you should. He's like, So I started looking at the competition there, and everything in Canada at the time, their whole model was earnout. Okay. So everybody was doing earnouts, and there was a competitor in Toronto, Toronto was the first market we went after. Okay. Because it's just a really large city.
Same time zone too as Charleston. That's good.
Yeah, and fairly easy to travel to. So I would travel up there and meet with the owners, and they were all kind of. I guess the mindset was just that's how firms are sold. They're sold on an earnout, and that's the only way to do it. Well, our model, even to this day, I mean, we do have only about 10 to 20% of our deals every year have any contingencies in them. We like the fixed price model for a number of reasons, and I can get into that separately. But we put a firm on the market in Toronto, the very first one we got, and we had 62 buyers look at it.
Oh my gosh!
And 60 said they would only buy on earnout. But 2 were willing to pay cash. Okay. And so one of them bought. So then once we got the cash model kind of entrenched in Canada, it just spread, and now that's pretty much the model in Canada on deals that are, under $5 million, even up to $5 million are cash deals.
Okay. Now, so tell it. I think in this podcast, Brandon, I want to get real practical. If somebody hasn't bought a firm or sold a firm, I want to be pretty instructive. There's so much you could teach us about that. So just start with what is earnout and what is paying for cash. And by paying for cash, you probably mean an SBA loan or partially cash, partially SBA. What is the difference between those two? And then we'll talk about why you like one over the other.
So let's talk about what an earnout is.
Okay.
A typical earnout structure, and let's just, for easy math, let's say a practice trades for 1 times annual revenue. Okay, so that's a kind of a standard rule of thumb in the industry.
It's more now,
and it's more. It's moving up, and it depends. There's a lot of factors. We can get into that.
Okay,
but just for easy math, let's say it's
1 times revenue.
Let's say it's $1 million practice, $1 million price. Okay. What the earnout offer typically would look like, or very frequently would look like, is, hey, I'll give you 20% now, $200,000, and then I'll give you 20% in the next 4 years based on what I actually collect and keep.
Right.
So you're only paying for what you keep. So that's the earnout model.
And what's built into that is the understanding that if the previous seller helps me retain the value, they're going to get their money. At least that's kind of the thought of an earnout.
Correct.
So you gotta keep that owner with you a little bit, or they do 1 or 2 years or something. Which that's probably part of your problem, I imagine, huh?
It's a big part of the problem. Okay. Well, well, it's confusing for clients. Like, who do I go to? I mean, I can talk on this topic for 30 minutes if you want to. Like, it's interesting. The problem with the earnout is the risk is in the wrong place. So who controls the service pricing decisions? Who controls the client service level after a sale?
It has to be
the buyer.
Yeah. It's got to be the one that bought the thing and now fully legally owns it. They have the right to do with that business what they want, or they should.
Right. So if they run off all the employees, or they're terrible at client service, or they're just, their communication's not good, or a number of reasons. Let's say the firm loses clients, or they lose staff, and then they lose clients because of that. That's really on the buyer. Those are the buyer's decisions that made those events occur. So you're, in my opinion, what you're doing is you're setting yourself up where the risk is in the wrong place. Because in an earnout, the risk is really on the seller. And so the seller, and then you're inviting the seller to maintain control over the practice, because the seller wants to look after the practice so that there aren't losses. And so then you get disagreements with buyer and seller, and two, the buyer is not going to be as incentivized as if it's their dime. If it's their dime, they're going to work hard, not just to maintain the practice, they're going to work hard to grow the practice. Because they get to benefit from everything they do. That's, so I feel like there's so many things that happen there that when you, and why, I mean, look at most businesses are sold on cash.
That's how that works.
Smaller companies. So why are accounting practices any different?
Right. And there's been a practice and tradition of doing earnout, I guess, over the history of selling our businesses. And the cool thing in our profession is that our businesses are very attractive to purchase. They are sellable. So you can get loans on them. How does the SBA work? The SBA is only, will they fund 100% of a purchase, or the different programs probably allow different things?
They will fund up to 100%. And that's typically, like, let's say you already have a practice, you can use your firm's equity so that you can borrow 100%. Now, if you don't own a practice, you've never owned a practice, you're probably going to have to put up a 10% injection of cash. And then sometimes the seller can finance 15%, and then the bank will fund generally 75%.
Oh, I see.
So,
okay.
And it depends on, they do look at like different factors there. The practice itself has to cash flow to be able to qualify for an SBA loan. And then, of course, the buyer has to qualify. So,
okay. Now, if there's a new buyer, let's say it's an entrepreneur and they know an accounting practice is a pretty good purchase, and they buy a $5 million business, that's a substantial company. Maybe the SBA would require some cash up. They want some risk on that buyer, basically. So sometimes will they bring some investors with them?
Well, we're seeing a lot more private equity interested in the industry. They're becoming very interested in the industry. Matter of fact, we've got one that's supposed to close, knock on wood, this week. That's a private equity buyer.
Okay.
And so there's definitely more money, and we are sort of working to sometimes back buyers that want to have the capital of a private equity firm, but they don't maybe have their own capital or enough of their own capital. So we're kind of playing around with that a little bit, of doing some matching with people who want to buy. And
wow, that's kind of more of a behind the scenes benefit you bring, right? Which is, I have the people to bring some of that cash you need to allow you to get that SBA to buy this $5 million practice, which is what I want you to buy. So you can you're kind of touching a lot of parts of these transactions now, which is pretty amazing.
Yeah, and I think the private equity thing is going to be really interesting for the profession. It's gonna play out in ways that is going to be interesting.
Yeah. Well, it's the people who really know it, people like you, and we know Alan Colton, who's doing a lot of the much larger private equity type purchases. A lot of people and some other consultants that buy and sell and do M&A work, a lot of them are just saying they don't know. Like it's too early to know, is this going to be a long-term good thing for the profession, or they don't know. I mean, what's your opinion, or do you not know? What do you think?
I think it's I'm an optimist, so I think it's going to be a good thing.
Okay. Why is that?
I think that there are so many accounting firms that there's a lot of opportunity that's untapped. And I think also a lot of CPA firm owners, I've been hearing for 30 years, like, hey, we need to focus less on compliance and more on
advisory,
add value with their advisory. But so many CPA firms are not doing that.
Yeah.
And I think the private equity is going to inject a lot of that professional, business-minded, those mindsets that come in.
Yeah.
I think it's going to shift the mindsets.
Oh.
And
okay, that's cool. And so you may see private equity invest in some level, and it brings everybody up to a more market-based, value-based model, which is how everybody competes. And then everybody else is going to have to come alongside and stop doing these dorky traditional things they've been doing all their life, right? Okay.
It's yes, exactly. It's going to like they're gonna come in with a cold eye, which that's where sometimes it might be negative for the profession, is maybe they'll lose some of that warm, fuzzy coziness. Yeah. But they're gonna come in with a cold eye. They're gonna manage by the numbers, and they're gonna make hard decisions that firm owners don't want to make.
Yeah.
And it's gonna be a little bit more business. It's gonna be disruptive. Yeah. But I think ultimately it's gonna result in a profession that serves clients better.
Right, because they run a business better. That's what it's going to force their hand to do.
Exactly.
Yeah.
Exactly.
And I guess, Yeah, and there's a lot of ways we could talk about how do traditional firms do it wrong. Of course, what is wrong, even what's right or wrong. These are very intimate business models, right? So they're very relational with team, relational with client bases. And so that's really what you're buying. You're buying some of this culture of a relationship. You got to do diligence to know about how loyal is this team to them? Will they be loyal to me? Were they part of a business that ran well? Or are they glad to see a new owner, though that may be fearful? There's all kind of things I guess a lot of us may not think about. But we'll run into more traditional practices, and they'll say, some of them, they're like, I run a $2.5 million firm, and me and my partner, we built it to do as much cash outlay to each of us as possible. And so then they get in, they're 65, and they're like, I can't now. If I sell it, I only get 2 years worth of my salary. So that's nothing, right? Because they're living on $500,000, $750,000 a year. But more savvy business people are actually building a business, leveraging team, creating team where this thing starts to operate on their own, and then they don't have to sell. They can stay there and be this CEO, this chairman, this chairwoman, whatever they want to be long term. Is that where this is going? Like, is that what people are learning, or what is changing from the way people did it traditionally? Maybe the baby boomers. I don't want to, just put everybody in a demographics box, but just that traditional generation may do it in different ways. What are they doing that's not working? How's it going to change? I'm interested.
I think it's really about resource allocation, and if you think about talent allocation, a lot of traditional firms, I would say the firm owners are working way too much in the practice. They're doing work that they're capable of doing higher level work. Yet they're still either doing actual tax return prep or doing review. They're just doing things that maybe they've been doing the same thing for 20 years, and they don't know that there's another way, and you can delegate. And so I think there's a lot, and this is, I'm painting with a very broad brush here, but sure. I think the firms that are, I'm going to say firms that are not changing and are kind of antiquated, perhaps. It's usually where the owner is just not delegating. They're not challenging themselves with learning and getting into advisory and doing more of the thinking work. Maybe it's a comfort, it's a perfectionism where they want everything to be clear and black and white. And compliance work can be fairly black and white. And when you get into advisory, it's a little riskier. It's not as there's less certainty. But the firms that are really moving ahead kind of fall into one of two categories. They're either going for that higher level work, that advisory, and they're letting their compliance sometimes fall away, or sometimes they're selling it off. They're divesting from that, and they're growing their teams. They're challenging their teams to do more of that high level thinking work. Or you have the other model, which is, let's create a machine. And let's automate everything. Let's get the best tech stack we can get. Let's do everything efficiently, but we don't really want anything too difficult. We just want to stick to our knitting and get really good at that one or two things. So I think those are the two models I think are going to be successful. But if you're kind of like if you're trying to be everything to everybody, it's not going to work too well.
Okay. So generalization, which is traditionally how firms have operated in the past 30 years, you're saying that's probably not going to work, especially as PE, private equity, comes in and it elevates the business stature of these companies and how they're run. We're going to all have to actually act like competitors, right? We're going to have to niche, price high. We're going to have to do these things that set us apart, brand ourselves, differentiate. That's going to be forced upon us. Is that how you would say it, or?
I think it's going to, I wouldn't say forced, but encouraged.
Okay.
Like, I think the market will, elevate those firms that are doing those things well, and the firms that are not doing those things are probably going to it's going to be harder and harder for them to attract talent. It's going to be harder and harder for them to maintain a decent margin. It's going to be harder and harder for them to sell their businesses. So there are going to be consequences. They might not be, either you exist or you don't exist, but I think the quality of that existence is going to vary greatly.
Yeah. Yeah. One thing that's interesting, and then, Brandon, I shared some questions with you. We're not getting to any of those, but because I can ask you a million things. But here's something you told me one time, and because you sell firms, you've been doing this for so long, which means you see patterns of how firm selling looks over generational and demographic periods. But you've told me the U.S. owners are different than the Canadian owners. They actually run their businesses different in terms of how much time off. And I thought that was fascinating. Can you explain what you've started to notice between the two countries and why the countries are different? I don't understand why.
I think there are some cultural differences.
Okay.
And they're definitely, these are, again, it's a big paintbrush here.
Yeah.
But one of the things I noticed, a couple of things I noticed when I started selling firms in Canada. First thing I noticed is I wasn't getting quick callbacks. And so like the timing, the pace expectation was a little more forgiving. And I didn't like that at first, but then I grew to really kind of like it. It's a little more laid back, and that's not everywhere. Toronto is an interesting city. Toronto has a different business culture than say Calgary. So, you have differences within the provinces of Canada. But I spoke with owners in Canada that took really long vacations, and it was much more acceptable culturally. I would get an email auto reply, "I'm out of the country until, for a month. I'll check my email when I get back." And I was like, wow. And so I actually got on the phone with one of these firm owners, and I had numerous discussions with this owner, and I knew he had a successful firm because he had shared his numbers with me. So that's another thing that we're privy to, is we see the numbers. So we can hear the stories, and we actually see, the numbers. And he had a really successful firm, and cash flow to owner was high. And, he hit me with one of these month off trips that he was taking. He goes, "Oh yeah, I do that every year." And I was like, "How do you do it?" He's like, "Well, the first time you do it, you think you're not going to have a business when you come back." He said, "But," he said, "it just works. The team steps up." He said, I have to prepare for this vacation. It's not like I just, decide to leave one day."
Right. That makes
he
sense.
said, I prepare my team. I notify my clients that I'm going to be gone. I pick a time of year when it's feasible. But he said, I work really hard during tax season. I work really hard at certain points in the year where I'm working overtime, and I'm giving my clients 110%. And he said, if you're going to perform at a high level, you got to take time off at a high level. So that's my philosophy. And he said, it gives you something to look forward to. He said, he and his wife, they go to all these places. They've been to Egypt. They've been to, Europe several times. And anyway, he just was a really big believer in it. And I've just encountered more and more of those instances in Canada. I had one firm we sold in Edmonton, and it was a one owner firm. He was grossing just over $2 million. His cash flow to owner was over $1 million. It was like $1.2 million a year, and he took 3 months off a year.
It's like, what?
And it's like, man, this guy's got it figured out.
That math don't work.
I don't know why it's different. I do know that there are cultural differences between the countries, but I think the result is it's possible.
Yeah.
Now, I do think,
That's
one of the
interesting.
things I've thought about this, so like tax planning is possibly more valuable in Canada than it is in the U.S. because of
Okay.
higher tax rates.
Okay. Yeah. Okay.
So the 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 public values the accountant because
Mm.
of the higher tax rates. They'd rather pay the accountant than Revenue Canada.
That's interesting.
Um,
Well, we have some members in Thrival that are Canadian firms, and they just lean heavily into tax planning for high net worth individuals. That's pretty normal for them, and it's
yeah,
complicated. So they just figured that out. So that matches what we've seen in some of the firms we have in our community. So
yeah,
yeah, very
yeah.
cool. Well, what about all right? So can you predict 10 years from now? You have to predict, Brandon.
Okay.
Are so I'm just curious. This is cool talking to somebody that's done this for so long. Like if you're thinking about kind of what you've experienced the past 10 years, I know you've been doing it for 20, but like the past 10 years, there's a lot of changes happening now. There always are, right? But baby boomers, there's a different labor market. The younger labor market just completely thinks about work in a different way. A lot of them are getting that right. Some of them are not getting it right. But what is the next 10 years going to look like for this buying and selling of firms, if you were to guess? Do you have thoughts about that?
Oh man, I I I would have thought like if you'd asked me 10 years ago what I thought would be today, I thought we'd be running out of buyers.
Ah,
You know, because of the silver tsunami was going to happen. Like, who's going
yeah,
to buy all these firms?
right.
And now, uh, 10 years later, we've got more buyers than ever,
Mm,
and a lot of it's because we have private equity and
mm,
we have um, I don't know why that is, but
yeah.
anyway, we have um, good buyers. So 10 years on, I think the profession will be. I think it will better serve the business owner. I think it will better serve the business owner.
Cool. That's
I'm
encouraging.
involved with, yeah, I think, I've been involved with entrepreneurs organization.
Mm,
So I helped start a chapter here in Charleston,
yeah,
South Carolina, where if you're not familiar with EO is a peer group
yeah.
and you meet once a month. It's a worldwide organization. And to join, you have to have $1 million in revenue. Um, and so I've met all these entrepreneurs in my local community, and so many of them have uh, surprisingly little financial knowledge,
Yeah.
right? Like, so you got these very successful entrepreneurs that don't know how to read a P&L. I mean, they really are. Some of them are ignorant on their finances, on their accounting, and a number of them expect, well, I've got an accountant. Why don't I understand these things? Why don't I understand my margin? Why don't I understand my cost structure? Why don't I understand how I need to price my services? Why isn't my accountant helping me with these things?
Yeah.
And I'm like, because you have a tax accountant,
Yeah.
and that person is not asking you these questions, and
Yeah.
they're not even, it's not even on their radar.
Uh-uh.
So
No.
if you're gonna go, if you need that service, and I can see you need that service,
Yeah.
right? You got to find somebody that's going to offer that service. And this, Jason. There's so many accountants; they're too busy to focus on that stuff.
Yeah.
They're too busy doing the tax notices or whatever it
Yeah.
is they're doing, and you're ignoring the very thing that where you're needed the most.
That's
Right?
right.
I've got one gentleman I know in EO. He's got a $20 or $30 million company, and he just got a fractional CFO to help him.
Wow.
I mean, so it's I think there's going to be more. That need is going to get filled.
Okay.
And private equity sees it. Like the people that see this industry, the reason private equity is coming into this industry is because they see an industry that's not serving the clients as well as it could. There's a lot of opportunity in this industry, or they wouldn't be interested in.
Yeah. To charge a lot.
So to charge a lot,
Yeah.
and to do the work that needs to be done.
Yeah.
And to stop doing the work that doesn't need to be done.
Mm-hmm.
And I think so. You're going to have this situation where you've got private equity coming in. So there's going to be more focus on that higher level work. And also you're going to have better automation, better tools, better tech stack that's going to take care of all the compliance stuff. And you're going to have a labor force that doesn't want to do that work really.
Yeah.
They don't want to work like the old firms work.
That's right.
So I think that's a trifecta that's going to really elevate the profession. And all of it seems very negative in some ways, but it's absolutely what I feel like is going to happen.
I love it.
And I don't think it's bad at all. I think it's good.
Yeah. Well, cool. Well, Brandon, we're going to take a quick break for a sponsor to give us some thoughts here, and we'll come right back with another question for you. I'm excited to share Divvy as an exclusive sponsor of the Thrivecast. Unlike expense management, spend management from Divvy now lets us provide cards to our team members, apply budgets to those cards with preset levels up front for each team member. And as we've implemented spend management, we no longer have to deal with the messy receipts on the back end of our expense management process. Check out getdivvy.com. That's GETDIVVY.com for more information on managing your funds and moving them to the front of your spend process. We're back. Thank you, Divvy, for sponsoring Thrivecast. So, Brandon, I'm interested in you kind of walking us through practically, because we've been talking about some high-level stuff, such good stuff. I could keep talking about that. But I want to ask you some practical things, like what are the different levels of the journey of an accounting firm's growth? Really, what are those things that drive the value of it? I think we've been touching on some of that. And then from that, I want to get into what do y'all do as a group? Like, you get the firm P&L. How do you add back? How do you really, come up with that cash flow, the thing that's sellable? I want to talk about some of that too. So what are these different levels, journeys of growth for firms that you typically see, and what drives that value growth?
Well, I think, I've seen firms all the way from startup, and up. And I love the startup. I love the person that just goes out and starts their own firm and puts a shingle out and gets it going. It's a hard road.
Mm-hmm.
It's a tough thing, but people still do it.
Mm-hmm.
And
I love it.
I think it's great. And so I think the first thing, I had this question. I spoke at the Zero Roadshow this summer, and I got this question from the audience. I'm a one owner firm. What do I need? What's my first hire? What do I need to do?
Yeah.
And I think the first hire is a really good admin person. Get that admin person. But as you grow, you're going to hit these. It's going to be a step growth, right? You're going to grow, and then you're going to hit this ceiling, and you're like going to be frustrated, and you're going to be working too much. You're like, got to be a better way, right? And that's when you have to
ceiling, right?
You got to push through. But I say you got to prune through that ceiling.
So cool. What does that mean?
I think it's a time where you have to prune. So
client base.
When you hit that ceiling, prune the client base. Sometimes you got to prune some employees that aren't working so well. Sometimes you got to prune entire segments of the business that aren't working very well.
Love it.
You got to free yourself up, and sometimes it's a great time to look at your pricing. Like, wait a minute, I'm working like this. Our team's working hard. Are we really charging enough? If you're having trouble getting the cash to grow, well, maybe maybe pricing is something you should really look at. And so I think those are kind of the things that get you to that next level. It's usually, and the staffing shortage has kind of been interesting because a lot of people can't hire staff. You can't grow by just doing more.
Yeah.
Oh, we just got to grow by doing more of the same.
Can't do that.
You got to get a little, you can't necessarily do that, or can't do it as fast as you want to. So then you're starting to look at these other strategies like, oh, well, maybe we need to really go up on pricing, and
Yeah.
maybe we need to weed out from the client base.
Yeah.
And so for me, like it's you got to weed the garden and get the garden really healthy and get it poised for growth, and then you grow to the next stage.
Yeah.
And then it happens all over again at some point.
Yeah. I love it. And that's what we do with gardens, right? In a season, we grow whatever we're growing, and then we go rip it all out, till up the soil. Yep. And you do that every single year, and and I guess there are, like, anecdotally, we tell people there are team sizes, right? You're starting to hit 5 to 8. You're going to run into your first wall. You're going to be like, I don't know how to run a firm with 5 or 8 people. And so that's where you're saying you got to start cutting some of that out, because probably by that time you've matured in a way that justifies your price being higher, but you haven't raised it up to match what you've learned and the value of your company at that size. And so if you do a little weeding, bump up the price, it starts to jack up your growth again. And then you're going to hit another one, right? 12, 15 people. These start to become places you can just start to count on hitting. Are those the places that people hit walls, or are there other ones you would tell us about?
I think I think you've hit it pretty accurately, and that can be different revenue for different people, right? Yeah. I think one of the things that's somewhat a magical spot for a firm is you hit that 5 million revenue mark. When you hit that mark, generally speaking, and we've had a lot of inflation in the last couple of years. Maybe it's 7 million now, but the magic there is you've got a team big enough to where the owner, you're not going to get pulled back in. If you lose a tax manager, if you lose a person, the rest of the work can be distributed to the team. So I think there is some real advantage to getting scale.
Okay. So it's interesting when we did an expert panel that this podcast is going to come out in September, so before Deeper Weekend. So we did an expert panel. You were on that. Brandon Hall was on that. Everybody gets to watch this film. And I remember Brandon saying a lot of people want to have a lifestyle firm. It's like, I'm going to have a lifestyle firm. And that's fine. But he said, I want the lifestyle firm that's big enough to pay me what I want to be paid. So what I had to learn is I don't get the lifestyle firm yet. I had to build, almost this $10 million firm, which is what he said on the thing. And he's like, now I can have the lifestyle firm. So I was like, okay, are people trying to get the lifestyle firm too soon? And does that come later? And I don't know, generally, Brandon, is it people are just trying to avoid the fact that building a firm takes work? It is years of hoeing and digging out the rocks and learning.
It is, but I believe it doesn't have to be that hard.
Okay.
I really firmly believe it doesn't have to be that hard.
So do we make it that hard somewhat, you're saying?
I think we do make it that hard, and I think we push ourselves too hard sometimes. I think, you do have to have time to plan your business. You have to have time to think, and it takes time to be strategic and to plan. Otherwise, you're just going to get on that treadmill every day and run as fast as you can. That's just not going to work.
Right.
Or it will work, but boy, it's going to be a hard road.
Yeah.
And I think Brandon's right, though, to build that infrastructure. You have to get to a certain size, and it's not always easy. But there are ways to make it easier.
Yeah. And it's tough. It doesn't mean we all know how to do that. You learn that through experience. So, and that's the thing.
Yeah.
And that's probably the struggle with any profession that has a technical mindset. That is, they're trained technically as a technician. I mean, engineers, accountants. When we run our own business, we have to really become really good entrepreneurs, and we don't have that skill. None of that's taught. Only technical is taught in school. So we've got to completely learn that on our own. People like Thrival, you guys have a class where you walk people through this. You just have to get that training out in the marketplace, and you have to have it, because there's a way to run a business and there's ways not to run a business. And learning it on your own can be extremely costly, very costly, because all of our costs come from labor. And you mess up a hire, golly, it's so expensive to reestablish a relationship with somebody you hired that was expensive, that didn't work out. Tough. So, well, Brandon, tell us, all right, so somebody comes to you and says, I want to sell my firm. What do y'all do? You get the P&L. What are you adding back so that you can say, now it's ready for sale and I can report on my website what people are going to get? What are some of those things you're doing, like, practically? I don't think we all know what that is.
So our process, we put a lot of front end work on creating that package that goes to potential buyers. Mm-hmm. And we want to get a very thorough understanding of the practice so that we can communicate what the practice is and what it isn't often. And so I feel like a good package that you're going to send to buyers should do a couple of things. Mm-hmm. It should resonate with the right sort of buyer, mm-hmm. and it should help filter out the wrong sort of buyer. What we do is we get tax returns, mm-hmm. because during the due diligence process, everything goes back to tax returns. Yep. So, we've learned that. We have learned that the hard way early on. You
didn't tie the P&L down to a tax. You thought the accounting firm's P&L matched their tax return. It didn't match. That's a trip. Wow.
There are occasions where it doesn't match.
That's funny.
And it has to match. So, so we build our profiles off of tax returns. Now, there are occasions where, you got multiple entities under one return and you got to split those out. And I mean, there are cases where, and we disclose that in our profiles. Yeah. But anyway, we do a lot of interviewing of our client, of our seller, to really understand what their goals are. Make sure the timing is right. The timing is the hardest decision sellers have to make. Okay. That's the hardest decision. Yeah. Because you and I were talking before we started recording, there's nothing more frustrating than you think you're buying a firm and then all of a sudden the seller goes, I really don't want to sell.
Yeah. That's tough when that happens.
That is tough. And that happens. Yeah. So we try to make sure our sellers are truly ready. And if they're not ready, we can give them some things that can help them get their practice ready, while they kind of are thinking about whatever is next in life. But most of it's through inquiry, and we do get tax returns. Now, as to your question about what gets added back, anything that sort of counts as owner's remuneration, like salary, insurance, retirement benefits, and then anything that's discretionary, like, for instance, maybe an automobile, that's the owner's automobile. Or there's can be kind of unusual items, like if somebody spends a lot of money on professional development, and the buyer might not want to spend that much on professional development. We'll highlight some of those things. Yeah. Those are your most common add backs. Interest on debt. So if there's an interest expense, that comes out. If there's any revenue that's non-recurring, that sometimes comes out too. Like, for example, there was a lot of money earned for all these ERC. COVID stuff.
Yeah, it makes sense.
That's a one-off.
You'll back that out.
All that one-off stuff. Okay. That's got to come out.
Okay. Very cool. Yeah.
Things like that.
Yeah. No, that makes sense. So you'll coach somebody if they're selling and you're asking them why they want to sell. If they're struggling to really know if they're committed to it, will you counsel them? It's like, hey, you may not want to get into this transaction like that. You need to go into this. Do you tell them you need to go into this ready to let go of this thing? Like, do you counsel them through that process?
We ask them some questions, and usually they come to the conclusion on their own. If they're not ready, it becomes apparent in our conversation. Yeah. It becomes obvious to them as it becomes obvious to me that they're not ready. Okay. And, we tell them, like, we want you when you're ready, not before. And so, and usually I tell you, most of the people that we talk to are not ready the first time we talk to them.
That's wild. Really?
You know, and they know, I mean, they know they're not ready, and they're just kind of planning and thinking through it. And
okay.
So I've had conversations with people. It's funny. The reason we started our academy is somebody called me and said, I want to sell. And one of the things we always ask them is about burnout. Are you just burned out? When's the last time you had a vacation? When's, do you love, if they say, I love what I do, but I don't want to do it anymore. Well, wait a minute. That's conflicting.
Yeah.
So, we'll kind of probe around and ask some questions about, what's really going on in the practice. Are they just overwhelmed?
Yeah.
And they just want to throw their hands up? Because that happens a lot.
Right. And that's not a time to sell. That's an emotional response to a circumstance. And you don't sell in emotional situations like that,
Right.
Yeah.
Because usually they come to their senses before they get to the closing table anyway. So, yeah.
You've jerked a buyer around.
Yeah, I heard a funny quote. It says, "I won't waste your time. I'm not going to let you waste mine."
Yeah.
So, I mean, we don't want to waste our time either. If somebody's not ready, we truly don't want to kind of push them into something they're not ready for.
Yeah.
So, often they're not ready and they have to think about it. And, that's a tough decision. We do have a article on our website that's on our blog that's about timing, which is I really think it's one of the hardest decisions sellers have to make.
Okay.
But two, sometimes they just want to understand what their practice is worth, which is they're kind of doing some financial planning.
Okay.
And they want to understand the value of their firm, and so we can help them get a better idea of what it's worth so they can plan.
Okay.
And that's
pretty cool.
That's really smart. Yeah. And you mentioned wanting to get into that. So, what we look at is how many buyers potentially are there for a practice. Yeah. That's ultimately what determines the price.
Makes sense. Okay.
If you've got high demand, if you've got a lot of buyers, potentially you're going to have a higher price and stronger terms. If there are no buyers for your firm, guess what? It's worth zero, right? So,
wow, that's hard.
So we look at the assessment. Like, okay, location's a good example. So, if you're a cloud firm, for example, well, a buyer from anywhere in the country could buy your firm. We see that happen. We've sell cloud practices all the time where the buyer's from another state.
Yeah.
Or if you're in a major metropolitan area like in Atlanta or Miami, something like that, there's a lot of buyers in that community that could help you exit.
Yeah.
In contrast with, like, if you're in a really small town,
right? Yeah.
That has a population of 10,000. Well, how many people are going to want to move to that community?
Yeah.
And how many people are in that community that could buy you out? So location is a good example of that. Profitability, there's going to be more people interested. The more profitable you are, the more interest there's going to be. Owner hours are important.
Yeah.
I mean, that's almost like the other side of the coin of profitability is how hard is the owner working?
Yeah.
And the newer generation of buyers, they do not want to work 3,000 hours a year. They don't want to work 2,500 hours a year. So, if you can make the practice less owner dependent as you approach the time to sell, that is only going to increase the value of your firm.
That's a value, yeah.
So, and then also sometimes the mix of services will come into play.
Okay.
One thing we're definitely seeing on smaller firms is buyers don't want assurance practices.
Okay.
So
compilation, audit, review, all that, right? Yeah.
Yeah, they just don't want the audit, especially. Like reviews, okay, but like the audit, especially. And what I see a lot of times, I've seen this less and less, but you'll have small firms with a really small percentage of the revenues is audit. And usually my advice for most owners is, let that go now. Just let it. Just
Wow.
somehow weed that out of your practice. You're probably not even making money. You're probably losing money on it. That's the first thing.
Yeah.
Is if you're doing a small amount of something, if you're dabbling in it.
Yeah.
If you really look at like how much CPE am I getting around this?
Yeah.
How much time are we putting in? How much learning is there? What's it and what's our opportunity cost?
Yeah.
Where could we put that time instead? Usually practices come out ahead if they cut that stuff off.
Yeah.
They definitely come out ahead when they go to sell.
Yeah.
So the mix of services can play into that.
Okay, that makes sense.
Yeah. And then there's curb appeal things, is the tech stack fairly good? Is the firm paperless, or is it, really old fashioned? Is it, what about the team? The staff is becoming a bigger and bigger consideration for purchasers, for sure. We like to see longer term staff. Not a lot of turnover.
Good stuff.
So, those are kind of the big things that drive value.
Okay. Yeah, that's good stuff. And a lot of that makes it.
Yeah.
What's that?
Yeah. I was going to say that, if you really want to boil it down, make it super simple, like how much what's the cash flow to owner?
Yeah.
And how many hours does the owner have to work?
Okay. Yeah. That's becoming
better
more.
Those metrics are.
Yeah. And that's becoming more and more attractive to even, younger buyers, which I think that's what we're seeing, right? Younger buyers are buying firms, right? That just makes sense because the older owners are selling. I don't know. Maybe the baby boomers aren't selling the way we thought they were. Maybe before the 2008 crisis, I think even back then I thought, well, the baby boomers are going to be retiring pretty soon, and they didn't. So they had to put that off. So we extended a little bit of that. Now we're into this labor crunch, and I guess it's I want to wrap up here, Guy. I mean, Brandon, I could talk to you about this forever. It was interesting, a lot of people go to your site and they're looking through stuff. Well, I saw Canada. That was interesting. Cloud firms became, of course, we've been virtual for over 10 years. So it's just a normal way we operate. I'm sure that has to do with how you purchase and sell firms too, because now you're not dealing with a lot of the things you normally would, but you also have other considerations. Are team able to be focused in their home? Are they long-term, and how long have you been, a cloud firm? So just maybe last couple minutes, give us some thoughts on cloud firms. Is that good, bad, better? Like, what are some specifics about somebody looking at a cloud firm to purchase?
I really like the cloud model. I think one thing I've noticed is like a lot of our cloud firm buyers and sellers tend to be a little bit more entrepreneurial than the traditional firm owners.
Yeah.
And so, I've had a lot of younger sellers sell cloud firms, and they go into a completely different industry.
Okay.
So that's been interesting. I think cloud firms, we did a pricing factors report just for cloud firms last year.
Cool.
And I think it probably needs to be revised because I think the multiples are increasing as the banks are getting more comfortable with these firms.
Oh, I see.
So so we were having a trouble with like valuations from the bank at the bank level. We'd have a buyer say, "Yeah, I'll pay that for it," and the bank says, "Well, we're not going to lend that much for it." So, so we were having some obstacles there, but those have started to ease. So I kind of feel like you're going to see higher multiples. The thing that I like about cloud firms is the growth rates. I think there's potentially faster growth potential for a lot of cloud firms. I see very rapid growth. I just talked to a guy today. He's got a 2-year-old firm. It's already generating $2 million in revenue.
Oh my goodness. Wow.
Yeah. How do you, So
fast,
we've
man.
seen it's fast. We've seen some very rapid growing cloud firms. So I think the potential is there. We talked about niching earlier. You can niche in the cloud space, and your client will value your expertise if you're in a particular industry. We sold one cloud firm we sold last year. Most of her clients were dentists all over the country.
That's a great market, man.
And so, great market. And so, she just the more of those clients that firm had, the better they got at serving dentists. They knew the KPIs that dentists needed to pay attention to. They knew the reporting that dentists needed. They could talk intelligently about practice management for dental practices. So the specialization possibility in the cloud is, I think, is a bigger opportunity.
Okay.
So
I love it.
But there's a lot of variables that affect cloud firm value. And the flip side of the high growth is cash flow suffers because, as you know, growth eats cash. So you have to
manage
invest in that growth.
Yeah. Well,
you have to manage that.
Yeah, I keep saying I have. That was the last question. I got one more question, Brandon. I know I have to let you go. Eventually, you have to go to freaking work, man. But just one question. So, as you're selling firms, are they more in debt than they used to be? Because you can use debt to grow, too. Are firms in debt generally more than they used to be, or less than they used to be? And so, if they sell, do they have to pay off some debt because they use it to grow?
That's a great question.
Or do you?
That's a great question. I don't know. I don't think I haven't noticed anything.
Okay.
I don't think too many firms are indebted to a high degree.
Okay.
I haven't seen too many that are, unless they've done a lot of acquisitions. We have seen people who have done a lot of acquisitions and use debt for that.
Yeah.
So generally when you sell, you got to pay off your debts.
Yeah. Okay. Yeah, it's interesting. Our firm, we niche into the large digital agency spaces, and a lot of them are leveraging debt more than they used to. It's hurting some of them, not everybody, but it's just something they're kind of leaning into. And it started with the pandemic when that blew up. Marketing, just tanked. It's like gone. Everybody's like, okay, marketing is completely gone, and that thing's been bumpy since the pandemic. So a lot of them have had to leverage debt. So I didn't know if that matches kind of the professional firm model, because anybody who's done it, we've done it. If you bootstrap your way through growth without debt, it's tough. It's tough to do because you're really trading revenue for buying that employee. You're having to just walk your way up through growth. And if it doesn't work, it kind of it hits you hard when you're not taking on debt to do that. So I just wondered about that.
I think maybe that's one of the benefits of accountants being a little bit more risk averse and change averse is they don't take a lot of debt.
That's true.
So
okay. Well, good stuff. Okay, Brandon, this has been fascinating. I can't wait for people to hear that. This is going to be a great precursor podcast before we go into our conference, where everybody's going to fly in from around the world. They're going to dive in and start trying to figure out what should they do next. Should they acquire, sell, merge up with other firms, or just start scaling, and growing their firm. So thank you so much for joining us on the Thrivecast. I really appreciate your time.
Oh, thank you. This has been a blast.
All right.
This was great conversation, Jason.
Cool.
Thank you.
I can't wait to be on yours. We'll see you, Brandon. Take care.